What's up, guys? It's your boy Looney. Today I want to talk about something that doesn't get shared enough on YouTube, and that's a huge mistake that I made with option trading, specifically covered calls. And this is a strategy that's supposed to be safe and consistent income, but when you don't manage it right, it could flip on you real quick. So I want to be transparent, break down what happened to me, and most importantly, the lessons you can learn so you don't repeat my mistake. But before we get into this video, quick shout out to the Discord. It is free to join. And then I also offer a premium membership, $8 a month, and it gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links that are in the description. But yes, covered calls can go wrong. And just to quickly go over what a covered call is, it is when you own 100 shares of a stock and you sell a call option against your shares. For doing this sort of trade, you collect a premium because you're the seller and you get paid that premium up front, which does feel amazing. But the trade-off is you're capping your upside. And if the stock runs too high, there could be some issues. And that is exactly what happened to me. So there's a few stocks, but essentially all the stocks that I bought up in April, I've been running covered calls. And unfortunately, I'm actually having to roll them and just overall figure these out. And I was doing them because it seemed good. Premiums seemed good. It was free money. The issue is the saying that you're collecting pennies in front of a steamroller. Eventually, when the market just rips, these trades get eaten away. And that is what is happening with these trades. SoFi and Riot. I have Riot pulled up, so might as well talk about it. I have 800 shares as collateral, and I'm constantly having to roll these because they're deep in the money, and the stocks are blowing past my strike prices. So these deep in the money covered calls, I'm having to roll, and to roll them, I have to pay. So let's look at this 12.5 because this one is coming up in about a week. And if we go to trade roll position, I could just let it go and let it get assigned and I lose my shares, but I don't want to. I want these shares. I want to keep these shares. I like Riot. I like it long term, and I need some volatility. I'm okay with the stock dropping, especially now. But to roll it, I usually go about a month. So this one is on the 26th. So let's go either October 24th or the 31st. Doesn't really matter. But when I go to roll, I like to roll upwards. If you roll too high, it is very costly. And we can look at that. So let's actually do that. So if we go to the $17 call to roll it, it is about $600 just to roll it, which is insane. That's an insane roll. And yeah, you can see that it can go wrong. These type of situations can go wrong. And if I were to roll this, it would cost me $600 to roll it to this strike price of $17. And then again, I get paid that $200, but it gets mitigated or it doesn't really happen because I have to close my first trade, which is a $500 close. And if you add the 2 to that 17, my break even is 19. So that does give me some breathing room, but it does hurt. It does hurt the account. And I do have to use my buying power to do this. And it is a very unfortunate situation, and I'm having to do that with a lot of these trades. This $12 call as well, if I go to roll it to, let's go to November this time. Well, this might be a little bit longer. And again, if I go up 1 or 2, this time I'll have to pay a lot less. But the issue with that is I'm going to have to continue to roll it. But how I'm going to play these, I'm going to continue to roll. I don't mind rolling these. I want to keep Riot. I like Riot long term. It's unfortunate that I'm having to roll and pay for these covered calls. And you can see it's adding up quickly. I'm paying a lot. I do have buying power, and I am up pretty big year to date and 1 year. So I don't mind losing some gains, but it's definitely hurting the ego and just overall hurting the mentality of investing. But that's okay. You learn lessons, and that's what really matters is learning from your mistakes. But I'm also figuring out I am combining other strategies. I have leap calls. I have called debit spreads. These are to catch the upside direction, whereas covered calls are kind of bullish, but because they're so deep in the money, my covered calls are definitely a bearish strategy at this point. So to handle this, I actually might open up some called debit spreads on Riot or SoFi just to help mitigate or catch the upside in case these run up further. But yeah, covered calls can work and they are a good strategy, but I'd probably do them a little differently. And I probably wouldn't do all my shares. I wouldn't make all my shares covered. I would have some uncovered, and that's exactly what I am doing. So, for example, Mara is one that I have only 100 shares covered. I still have another 100 shares that are uncovered, or really 112 that are uncovered. And this way, if the stock runs really high, I can actually let those shares appreciate and capture those gains. But unfortunately, SoFi and Riot are in those situations where I can't do that. All my shares are covered, and I don't want to buy I don't want to buy Riot or SoFi at these prices because I'm up so big. I don't want to catch into those. So I'm doing other strategies. I'm buying open. Open's a more speculative play. I wouldn't say it's a hedge to the covered calls, but at least if the market runs hot, a play like open will do well. Along with crypto, I own a lot of crypto. So Riot and Mara are crypto mining stocks. So they kind of go hand in hand. Crypto goes up, crypto mining stocks go up as well. And at least with crypto, you can't run covered calls. So these can run up as much as they want, and I won't have to worry about it. And I do take profits. So I take profits from crypto sometimes. So I'm okay with it running hot and overall dealing with this entire situation. But what are the 3 big lessons I've learned from this? One is don't sell calls too close to the money, especially in a bullish market. If the stock is strong and momentum is building, the risk of getting blown through your strike is high. Number 2 is rolling does work, but it does cost. Rolling is a great tool, but if you're constantly paying debits to do it, you're eating into all that safe income everyone hypes up. Number 3 is sometimes buying and holding is just better. And if I just held my shares, I'd be way further ahead. Covered calls are great in sideways markets, but when things are ripping, they do become a liability. So moving forward, what am I doing? I'm being a lot more strategic. I'm selling covered calls only when the stock is overbought or near resistance. And you can see that with Mara. I have a high covered call, and it's at that $21, I believe, which again is still possible. It can go to $21, but it is really far away or out of the money when I first did it. I'm also looking into debit spreads or just leaving some shares uncovered so I can ride the momentum. So covered calls aren't bad. I still use them, but the myth that they're free money is not true. They're income with trade-offs. And if you don't respect that, you'll end up in my shoes, paying thousands just to keep your shares. So yeah, that is my big mistake. Learn from it, don't repeat it, manage your strikes, understand your risk, and never assume an option strategy is flawless. Until next time, peace.